Hi, my name is Hassan bin Tariq. Today we're going to discuss IAS 12 income taxes in our channel about education and technology. Global Tech on Tube has already published quite a bit of the videos on the standards, which are the international accounting standards. And the standards that have been covered so far by Global Tech on Tube include IAS 2 inventories, IAS accounting policies, change in accounting estimates and errors. We have discussed about IAS 16 property, plant and equipment, IAS 17 leases, IAS 18 revenue. And today our topic is IAS 12 income taxes, and we're going to discuss the brief overview. We're going to let you know about the interpretations and also the key definitions and concepts like current tax and also the deferred taxes with the relevant formula. So without wasting any time, as the standard is being published by International Accounting Standard Board, so it has to be followed in verbatim. So just following the procedure as in our previous videos, we're going to tell you about the verbatim wording of the standard, and in this video it's all about IAS 12 income taxes. So what's all about? IAS 12 income taxes implements a so-called comprehensive balance sheet method of accounting for income taxes, which recognizes both the current tax consequences of transactions and events and the future tax consequences of the future recovery or settlement of the carrying amount of an entity's assets and liabilities. Differences between the carrying amount and tax base of assets and liabilities are carried forward. Tax losses and credits are recognized with limited exceptions as deferred tax liabilities or deferred tax assets, with the latter also being subject to a profits test. IAS 12 was reissued in October 1996 and is applicable to annual periods beginning on and after 1 January 1998. And related interpretations are IFRIC 7, applying the restatement approach under IAS 29, financial reporting in hyperinflationary economies, IFRIC 23, uncertainty over income tax treatments, and we also have amendments under consideration by the IASB. And so one of the amendments is a research project, which is income taxes, and it's a longer term project. Summary of IAS 12 is already been discussed so far, and the objective of IAS 12. The objective of IAS 12 in 1996 is to prescribe the accounting treatment for income taxes. In meeting this objective, IAS 12 notes the following: it is inherent in the recognition of an asset or liability that asset or liability will be recovered or settled, and this recovery or settlement may give rise to future tax consequences which should be recognized at the same time as the asset or liability. An entity should account for the tax consequences of transactions and other events in the same way it accounts for the transactions or other events themselves. The key definitions that we're going to come across in the standard are tax base. The tax base of an asset or liability is the amount attributed to that asset or liability for tax purposes. Temporary differences between the carrying amount of an asset or liability in the statement of financial position and its tax basis. And taxable temporary differences, the temporary differences that will result in taxable amounts in determining taxable profit, tax loss of future periods when the carrying amount of the asset or liability is recovered or settled. Deductible temporary differences that will result in amounts that are deductible in determining a taxable profit, tax loss of future periods when the carrying amount of the asset or liability is recovered or settled. And deferred tax liabilities, the amounts of income taxes payable in future periods in respect of taxable temporary differences. Deferred tax assets, the amount of income taxes recoverable in future periods in respect of number A, deductible temporary differences, number B, the carry forward of unused tax losses, and number C, the carry forward of unused tax credits. Current tax for the current and prior period is recognized as a liability to the extent that it has not yet been settled, and as an asset to the extent that the amounts already paid exceed the amount due. The benefit of a tax loss which can be carried back to recover a current tax of a prior period is recognized as an asset. Calculation of deferred taxes. How we're going to calculate the formula? Deferred tax assets and deferred tax liabilities can be calculated using the following formula. Temporary tax is equal. Temporary differences is equal to carrying amount minus tax base, and deferred tax asset or liability is equal to temporary differences multiplied by tax rate. The following formula can be used in the calculation of deferred taxes arising from unused tax losses or unused tax credits. Deferred tax asset is equal to unused tax loss or unused tax credits multiplied by tax rate. And tax basis, the tax base of an item is crucial in determining the amount of any temporary differences and effectively represents the amount at which the asset or liability would be recorded in a tax-based balance sheet. And we are just going to discuss about the examples. Determination of the tax bill could depend on the applicable tax laws and the entity's expectations as to recovery and settlement of its assets and liabilities. The following are some basic examples. Property, plant and equipment. The tax base of property, plant and equipment that is depreciable for tax basis that is used in the entity operation is the unclaimed tax depreciation permitted as deduction in future periods. Receivables. If receiving amount payment of the receivable has no tax consequences, its tax base is equal to its carrying amount. Goodwill. If goodwill is not recognized for tax purposes, its tax base is nil. No deductions are available. Revenue in advance. If the revenue is taxed on a receipt but deferred for accounting purposes, the tax base of the liability is equal to the carrying amount. Conversely, if the revenue is recognized for tax purposes, when the goods or services are received, the tax base will be equal to nil. And loans, if there are no tax consequences from a repayment of the loan, the tax base of the loan is equal to its carrying amount. Recognition and measurement of deferred taxes. Recognition of deferred tax liabilities. The general principle in IAS 12 is that a deferred tax liability is recognized for all taxable temporary differences, and there are three exceptions to the requirement to recognize the deferred tax liabilities, which are liabilities arising from initial recognition of goodwill, liability arising from the initial recognition of an asset liability other than in a business combination, which at the time of the transaction does not affect either the accounting or the taxable profit. And number three is liability arising from taxable differences associated with investments in subsidiaries, branches and associates, and interest in joint arrangements, but only to the extent that the entity is able to control the timing of the reversal of the differences, and it is probable that the reversal will not occur in the foreseeable future. Example, an entity undertaken a business combination which results in the recognition of goodwill in accordance with IFRS 3 business combinations. The goodwill is not tax depreciable or otherwise recognized for tax purposes. And the same applies for recognition of deferred tax assets, measurement of deferred tax. And we just going to talk about the deferred tax asset is recognized for deductible temporary differences, unused tax losses, and unused tax credits to the extent that it's probable that taxable profit will be available against which the deductible temporary differences can be utilized, unless the deferred tax asset arises from number A, the initial recognition of an asset or liability other than in a business combination, which at the time of the transaction does not affect accounting profit or taxable profit. And measurement of deferred tax assets and liabilities are measured at the tax rates that are expected to apply to the period when the asset is realized or the liability is settled, based on tax rates laws that have been enacted or substantially enacted by the end of the reporting period. And recognition of tax amounts for the period. Amount of income tax to recognize. The following formula summarizes the amount of tax to be recognized in an accounting period. Tax to recognize for the period is equal to current tax for the period plus movement in deferred tax balances for the period. And I hope that we have covered quite a bit on the standard, and you can go through about the presentation and disclosure in the link given below, and you can actually get the details that how it will be disclosed and how it will be presented in financial statements. So I'm going to end up my video about IAS 12 income taxes. I know that we haven't discussed about the examples in detail, or haven't applied the standard to the examples or to the course content, but moving ahead in our channel, in our videos, we're definitely going to go with different sort of the concepts in which, and different type of the financial statements in which we're going to discuss all the concepts. We're going to apply all the standards and concepts that we have covered so far in our channel, and I hope that we're going to be moving ahead with one step to another, and also developing the pace to improve together, and also in a good and handsome manner. And I hope that you're going to like our content on this standard. Obviously, the standard is the language is already been written by the management, by the experts on the given subject, but the purpose is just to share the content so that you can actually recognize in a quick and in a familiar way, such as on YouTube. So without actually moving ahead, I'm just going to end up my video. I hope you're going to like our videos that we're going to share ahead in our future. Please subscribe, give a like, and also give a comment, and also press the bell button for notification. I appreciate that you're going to do this, and thank you again. Take care and have a nice day.